This is the Wealth Roundup with Patrick Leonard from the Leonard Wealth Advisory Group of BMO Nesbitt Burns. Any postings and or social media content are the views of the advisor and do not necessarily reflect BMO's position or viewpoint. The information herein is for Canadian residents only and does not constitute any financial, legal, tax, investment, or other advice. Episode number 52 of the Wealth Roundup. For wealth management and to start your investment journey, find Patrick Leonard's contact information at www.patrickmleonard.com. The Wealth Roundup for the week of August 14th, 2026, with Patrick Leonard from the Leonard Wealth Advisory Group of BMO Nesbitt Burns, back from a quick little summer vacation, all refreshed and ready to go as we get closer to fall, Patrick.
Yeah, and you know what? Today actually feels like summer. You know, if we could just take today and repeat that for the rest of summer, that would be great. You know, this temperature is nice. Blue skies are phenomenal. No smoke in the air. You and I were just kind of talking offline about, you know, all the various forest fires, especially in BC. So a shout out to all those first responders that are out there doing all that hard work to keep people safe. But yeah, we had a nice break, and yeah, I just hope for the rest of summer is great too.
With us being off for a week or two there, did it follow in the past sort of same tradition? When we take a little bit of time off, we come back and there's some mishigas happening with the markets.
Yeah, it sure did. At least I think we're running 3 for 4 right now. 3 for 4. So that's not bad, right? And you know what? That's probably about the average. You know, we always kind of say the markets are up about 70% of the time. So we're batting about 75%, you know, when we look at our time off. US market is down a little bit today, but up, you know, over the last month. Sitting at about 12% on the S&P 500 year to date, which is great. Canadian market actually slightly better, up about 3.5% since our last podcast, sitting at about 14% year to date. Obviously, we're very happy with that. Oil prices, you know, so surprise, you know, in the Middle East, these, you know, concerns continue to kind of rattle the markets, pushing up oil prices. Recall there that you know, as we kind of watch oil prices, we know that kind of percolates into most goods. And as you know, the cost of production, you know, usually your two highest costs are energy and labor. So higher energy costs are going to lead to higher inflation. With that being said, we're actually kind of looking out 12 months, and we might our expectations are to see inflation cool. But oil's trading at $83, up about $5 US since our last call. Western Canadian Select just under $70, so up about $3.50. Gold has had a nice rebound, sitting at around $4,400 US an ounce. Bitcoin is flat. So, you know, I think my kind of takeaway there with gold is I think gold too is also kind of, you know, perhaps kind of forecasting that maybe rates might not have to go up as high as perhaps we were talking about at our last call. But as we go through the podcast, we'll kind of come back to that.
What were all the AI news with? Was it dividends or earnings or something that came out over the past week, 10 days that ended up making a bunch of news?
Yeah, so I think it's one of these cases of, you know, winners and losers. And so, you know, a good example of that, you know, kind of a case study, take a look at, say, Microsoft and Meta, so Facebook. And so we just came through earnings season where, you know, about 90% of S&P 500 companies actually exceeded their expectations, and we had pretty lofty expectations. So that's, you know, that's a really good number. You know, our forward-looking earnings on the S&P 500 continue to be really good, you know, over 20%. But, you know, kind of within those numbers, you can look at some individual businesses, and we got to remember the stock market is a market of businesses. You know, the market was quite happy with Microsoft's results, and you know, if we go back about 6 months ago, Microsoft had some disappointing results, specifically with their cloud business, and you know, the stock dropped about 25%, which is hard to believe because, you know, we kind of think of the context of most of our storylines with these Mag 7 businesses is that it's mainly been up. So for a stalwart like Microsoft to have the big sell-off that it did was quite surprising. So we come into earnings, and Microsoft comes out and really good, strong earnings results. So they are finding success in monetizing their investments in their AI build out, their AI business across actually all their lines of businesses. And then we see, Meta, which is really struggling. They're out there spending probably close to $60 billion a year on capital spending, but the results aren't there. And so you see the big sell-off. And so this is, we had kind of talked about this in our December forecast for the year, is that we would see winners and losers. And when it's one of the large market cap stocks, one of the big hyperscalers like a Meta, is it does have a big impact on the S&P 500 composite. Certainly something to kind of take a look there. The other kind of two themes that I think we're going to kind of continue to watch is the Middle East. Tensions going back and forth. Some weeks there's a deal, other weeks there's no deal, right? And oil prices have pretty much kind of followed that speculation. And then the third thing is the Fed. So what's the U.S. central bank going to do with interest rates? And so the big item there was we had a weak U.S. jobs report come through. So 23,000 less jobs. They were expecting the job numbers to be better. So, if you are somebody that is hoping that rates in the United States do not go up, or you hope that maybe U.S. Rates will eventually go down, there's a tick box there. Weaker job report. Maybe, if you've got less jobs, perhaps consumers are a little bit weaker on the spending side, maybe drives inflation down. On the upside for inflation, we look at those energy prices, rising. That's kind of a tick box for the side of, rates perhaps having to go up. So it's this constant kind of tug of war. Will the Fed tighten? Will the Fed loosen? We'll continue to watch it. Right now, the position of BMO Capital Markets is we do not see a Fed rate hike by the end of the year. Now, on the flip side, if we kind of talk about Canada, is that obviously we just kind of talked about the TSX outperforming the S&P 500 on a year-to-date basis. That's great. We've also seen a bit of a springback on GDP growth. So you remember we were talking about, probably about 8 weeks ago, we were talking about Canada being in a technical recession, but we weren't really overly concerned about that because we kind of felt that we would see some positive GDP growth later in the year. And we're seeing that. So if we compare where we were last year, so year over year, June to June, is we're actually seeing about a 3% rise in GDP for Canada. So some nice positive momentum there, probably on the back of strong commodity prices kind of across the board, which is, supportive of exports. And I also think too, we're coming off of a lower GDP number last spring, when we're still kind of talking about, tariffs, which continues to be a theme that we're going to continue to watch very carefully. So kind of a mixed bag, but clearly it's panning out good for the markets.
What about the investment outlook here since our last podcast a couple of weeks ago? Has there been any drastic changes or adjustments that need to be made?
So with the TSX and S&P 500 kind of significantly higher than our initial forecast for where those markets would be for the year, is that we are tempering expectations. But for the most part, with forward guidance continuing to look positive, AI investment continuing to be a big driver of both spending and consumption, is that we're generally continue to be optimistic about the potential for further returns in the equity markets. I think the key thing to watch out for is valuation. So not every business is going to benefit at the same level. And so while earnings continue to be good, fundamentals continue to be good, things look expensive. So prices look high. So even with the expectation that we're going to see higher future revenue down the road, stock prices are already pricing in a lot of that future revenue growth. So that would be the thing to keep into mind. Is I think lower expectations, still expecting positive, but we're really, really kind of careful about price. Price is really key at this point because valuations are looking a little extended. I would say the Canadian market probably looks a little bit cheaper than the US market. And even the European market, we don't talk about Europe very, very often. But outside of North America, we see more attractive valuations there as well. So that would be something we'll continue to monitor in the podcast for the remainder of the year.
Ken and Karen, investor, want to put some more money to work right now. How would they go about doing that based on their comfort level, risk level of whether they're a conservative investor or a risk-loving investor?
I think that's a great question. And you frame the question really well, is that, there isn't one solution that works best for every type of investor. So, just kind of talking about those conservative investors that are out there, and whether or not a person has always been conservative, or perhaps maybe what's going on in the Middle East has kind of concerned somebody, or maybe a person is just kind of feeling at this point, they want to take some risk off the table. Because I think that investor is actually perhaps benefiting from the fact that interest rates are a little bit higher than we expected. Mortgage rates are up a little bit. Guaranteed investment certificate rates are up a little bit. For those clients that are investing in GICs, I've always kind of advocated for a laddering type strategy, trying to add some duration, so some longer term in there, so you can benefit from some higher interest rates. So if we look at where we were on, say, 5-year GIC rates 6 months ago, we were probably sitting at around 3.75%. And today we're actually slightly above 4%. So, that longer term investor that doesn't need the money now has perhaps bought some other GICs, but now has some more money to put to work, has enough cash flow, maybe doesn't need the liquidity from the new money they're putting to work, they're getting a better yield. I actually had a question come in from one of my clients who is a regular listener to the podcast, and they're asking about bonds. And so, some bonds that we had purchased kind of earlier in the year were kind of reflecting a negative value. These are bonds that are coming due in the next 3 to 4 years, down about half a percentage point, on their statement. And they were asking that question about, with their bonds, why is their bond kind of down in value? And so this is something that's a really good kind of learning piece for people that are buyers of bonds, is that in general, bonds and GICs at the same term have very similar yields. Depends on who the issuer of the bond is, whether or not it's a very conservative issuer, like, say, a government, federal government, provincial government, municipal government, or whether or not it's a corporation. So, we tend to buy a lot of corporate bonds, investment grade corporate bonds. And so if we have a 3-year GIC, a 3-year bond, the yield should be very, very similar. Difference is that 3-year GIC, you have no ability to cash that GIC in. So that GIC is really going to just, if you bought that GIC for $100,000, it's going to trade at $100,000 until it matures, because you do not have the option to sell that GIC. In behind the scenes, if there was if there was kind of an emergency and you had to break that GIC, you'd actually find out that you probably are going to take a loss on that GIC, but it's not published on your regular statement because it's not a case where you're having to break it. Whereas that GIC trades in the market every single day. We get an updated quote on it probably every 20 seconds in terms of what the value of that bond is if you had to sell it. So really, that bond is reflecting that breakup value if you had to sell that bond between the date that you bought it and the date that it matured. So if you own an individual bond, or you have what we use quite a bit with Leonard Wealth Advisory, target date bond ETFs, so we know that they're going to mature, we know the month that they're going to mature, the year that they're going to mature, is if we hold that bond to maturity, we're going to get every penny that we expected. But between now and the time that bond matures, we're going to tell you what you're going to get for that bond if you had to sell it. So the inverse relationship is the market value of bonds tends to fall in market value between the date that you bought it and the date that it matured if interest rates are moving up. If interest rates are moving down in the background while you still own that bond, you actually might see a bit of a capital gain where that bond is actually worth more than what you paid for it. And so if you were to sell it, you would actually get more than the face value of what you paid for that particular bond. So it's a really interesting relationship between interest rates and bonds. If interest rates were not to change, or the expectations for interest rates were not to change, is that our expectation would be is that bond should really kind of hold its value or move towards par, between your issue date and the maturity date. So I think for conservative investors, probably a little bit more opportunity than maybe there was 6 months ago. For risk-loving investors, so investors that are looking at equities, we talked about valuations being stretched. And so I think in the US market, if we kind of take a look at the S&P 500 versus the S&P 500, the S&P 500 composite versus the S&P 500 equal weight, is that I think either of those indexes, or a proxy, a bundle of stocks or ETFs or a US equity mutual fund, is that they should all perform positive in this particular environment. But if a person wants to maybe take a little bit risk off of that, we definitely like something that's managed, or the equal weight, so that we don't have quite as much risk built into those Mag 7s. Because right now, we have the Mag 7 stocks, those big hyperscalers. They account for about 35 to 45% of the entire market cap of the S&P 500. So it'd be my preference to be able to try to get the same or approximately the same amount of growth, but with way less risk by going and diversifying those holdings away from those Mag 7 stocks. And I think on the flip side, and we've talked about this before, is that maybe somewhere in between being very conservative, so risk averse, and somewhere, on the other side of the spectrum where you're risk loving, is that in the middle, look at some type of equity that's going to pay us a yield, and that yield gives us some rent while we hold the stock. And I think in this particular environment, that probably is the Goldilocks solution. If you're looking for about somewhere in the middle. And I always find that when I'm talking to clients about where they should place their money and kind of talk about the alternatives, is that most people end up, they want to be somewhere in the middle, is that they don't ever want to be completely to one side and completely risk averse, and they always get kind of too concerned that perhaps they're taking too much risk. And so I think that that holding with some type of a strong dividend payout, there's lots of options that we can discuss for our clients.
Further discussion, more information, and of course, wealth management. And to start your investment journey, you can find Patrick's contact information at www.patrickmleonard.com. That's episode number 52 of the Wealth Roundup with Patrick Leonard from the Leonard Wealth Advisory Group of BMO Nesbitt Burns.
Thanks, Terry.
This has been the Wealth Roundup with Patrick Leonard from the Leonard Wealth Advisory Group of BMO Nesbitt Burns. I'm Terry Evans. The Wealth Roundup is part of the Reluctantly Podcast Network.